folks, Rachana Ranade here, and I welcome you all to a very special Thursday live stream. Why special? Because generally every single Thursday 9:30 we start with a specific pattern of our live stream. First, we discuss about technical analysis. We talk about the levels at which Nifty is. Then we talk about the option chain. Then we talk about the macroeconomic factors. Then we talk about stock specific information. And that is how our Thursday live stream has been since, I don't even remember since what day, what month, what year, but that's what we have been doing for quite a long, right? But today I just thought that let us try and break the monotony of our Thursday live streams, and I thought of inviting a very special guest. The guest needs no introduction, and it happens so many times that it is said that the guest needs no introduction, and then the whole introduction of the guest is given. So I'm not going to do that. I'm just going to request the guest to come on the stream, and once he's there, that's it. I'm not going to give any introduction. Okay. So welcome Saurabh and Krishnan. How are you all?
Yeah, fine. Thank you. Thank you very much, Rachna, for that remarkable introduction.
Thank you, Rachana.
Thank you. Krishnan, I would want to just a one-liner for Krishnan. He's the head of the investment advisory business, and I'm sure he's also going to give great inputs of whatever questions we are going to ask. So I thought of doing this live stream because there are a lot of questions that retail individual investors have in the current market right now. I did see a lot of WhatsApp messages circulating that market was exactly at the same place at what we are today almost a year ago. So many people are confused right now as to what are we really doing right by investing in the stock market. They just kind of get stuck up at what should we be doing in such a scenario. Should we be averaging? Should we be selling off whatever we have and what not, right? So I just thought of asking that whenever in such a scenario, when markets have been nowhere, going up down at a similar level, what all are the stock specific parameters that we should think before buying any stock? As I mentioned, it could be in something like a current market scenario, or maybe in a bull market or bear market, whatever is it. But what are the basic parameters? If you can give some quantitative parameters as well as qualitative parameters, that will be amazing. Any one of you can answer
Sure,
this.
sure. So look, I mean, I've always believed that looking at share prices, whether on a daily basis, weekly basis, yearly basis, is a complete waste of time. If looking at share prices could make people rich, then there would be no need for people like us. Anybody could look at the share price and say, stock is up YOY, let's buy more, right? So share prices are fundamentally useless. Just as Sachin Tendulkar did not become Sachin Tendulkar by staring at the scoreboard, he became Sachin Tendulkar by going to Shivaji Park and training for hours under Ramakant Achrekar. Similarly, for investors, looking at the scoreboard, looking at the share prices is not going to tell us anything. There are three metrics that we use to measure the health of our companies. Whether the share price is up or down is somewhat secondary. First metric, the kind of brahmastra of investing, I would say, is ROCE, return on
Okay.
capital employed. So in the algos that Krishnan uses to invest, the algos that Krishnan uses to advise our clients, return on capital employed, which is operating profit divided by business में कितना पैसा लगाया है promoter ने, return on capital employed is the probably the single most important metric. If ROC is below 15%, as it is for the vast majority of Indian companies, life will be tough for that company. Pre-tax ROC below 15% means basically companies not making money, right? They might show pat shat, but in terms of real paisa, हाथ में रोकड़ा, pre-tax ROCE below 15% means पैसा नहीं बन रहा है. We try to invest in companies with pre-tax ROCEs of 20, 30, 40, in some cases 60, 70%, right? That the stronger the ROCE, if year on year ROCE is trending up, it's fundamentally a sign of a muscular, strong franchise generating plenty of surplus capital. Then the second metric we place a lot of importance on, Rachna, is cash conversion. So out of every 100 rupees of operating profit, how much operating cash flow are you generating? Right? Because this is an indicator of fraud. So in our fraud screens, in our forensic screens that Krishnan runs, CFO to EBITDA, for every 100 rupees of operating profit, operating cash flow हाथ में कितना आ रहा है, that is a measure of, is this business actually stating real profits, or is promoter ji doing something naughty? So So, for example, there's a prominent pharma company whose
Okay.
cash conversion ratio is very low. We
Mm-hmm.
spotted this a decade back. Started getting into some serious trouble in the last few months, and I
Mm-hmm.
suspect next 2 years, this prominent pharma company will blow up. When it blows up, most people in our country will say the same thing, that "Pata nahi tha, how are we supposed to know?" The answer is you're supposed to know, because you should be looking at CFO to EBITDA, cash
Got
conversion ratio, not looking at that pharma company's share price. Share price, I stress again, has zero information value. Right? So, दूसरा metric to check naughtiness, check fraud is cash conversion ratio. And the third metric, which is a measure of financial health, is leverage, right? Debt
it.
equity ratio, right?
Mm-hmm.
Debt equity ratio in India above zero point 0.5 is khatre ki ghanti, right? It does not matter share price अच्छा कर रहा है बुरा कर रहा है. Debt equity above zero point 0.5 khatre ki ghanti. So these three metrics we place a lot of importance on: ROCE, CFO to EBITDA, cash conversion ratio, और तीसरा debt equity.
I had one or two questions on whatever you told right now. Like you said, Roki, minimum 15% is what is your benchmark.
Hmm.
But would it be different for different kinds of companies? For example, would you have it different for manufacturing set of companies, something different for service sector companies, or would you have it as a flat benchmark?
हाँ जी. So obviously in the context of a specific sector, so say a sector like IT services,
Mm-hmm.
where there is no fixed assets employed,
Mm-hmm.
naturally ROCEs tend to be high,
Correct.
and therefore when we compare TCS to Infosys, we might say किसका रोकी better है. But in such industries, रोकी is actually not a particularly powerful metric, right?
Mm.
ROCE as a measure of financial viability is a very powerful metric, because what happens is, companies which don't make any money, cash flow नहीं बनता है, they will inevitably say that look, our ROCE is low because हमारा business तो asset intensive है. We
Mm.
understand that, but the point is आपका रोकी लो है, आप asset intensive हो, लेकिन आप पैसा नहीं बनाते, that is a big problem.
Got it. Got it. And the point you mentioned for debt to equity 0.5 on a higher side, generally whatever we learn in colleges or in courses, 2:1 तक ठीक बोलते हैं. So any specific thought process behind this 0.5 ratio?
So lovely point, right? 2:1 बोलते थे एक जमाने में, when India was a old fashioned economy, right? हथौड़ा पीट के फैक्ट्री बना के टेक्सटाइल फैक्ट्री बना रहा है, कोई सीमेंट का फैक्ट्री बना रहा है, कोई पावर प्लांट लगा रहा है,
Mm.
right? We used to be a country where दिमाग का कुछ खास इस्तेमाल नहीं था. We were
Mm.
largely a capital heavy manufacturing economy.
Mm.
Increasingly over the last decade, Rashna, capitalism at its best is characterized by the use of the brain rather than by the use of heavy fixed assets, right?
Mm.
So if you notice, right, over the last 10 years, if you take the top 20 wealth creators in the Indian stock market in the last 10 years, the top 20 wealth creators in the last 10 years, they have created around 85 trillion of rupees of wealth in the last 10 years. Indian stock market has created 105 trillion of wealth in the last 10 years, 105 trillion rupees. 85 trillion has come from 20 companies. Hardly any of them will have debt. So this
Mm.
is companies like TCS, Infosys, Asian Paints, Titan.
Mm. Mm.
The financial services companies will have debt. Obviously, an HDFC Bank and ICICI Bank will have debt, but they'll have the standard debt equity ratios of around 10 times that a good bank does, right? In the
Got it.
top 20, the top 20 wealth creators in the last decade, the only company that carries any meaningful debt load is Reliance Industries, right?
Mm.
It's a big
Mm.
wealth creator. It's a singular company which is able to carry a big debt load and create wealth.
Mm.
Typically in India, 2:1, kya even 1:1 debt equity ratio wale are no longer relevant in the wealth creation stakes, because as soon as a company has debt in modern India, it's a
Mm.
sign that there is a bit of a problem. Even one times debt equity,
Mm.
even one times debt equity is often a signal in India that something is going awry, and that's
Okay.
why we said half a times debt equity tends to be a good number. Uske upar ja raha hai, that
Mm.
means there is something gone wrong in the cash generation engine.
Mm. 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 Talking about cash generation and EBITDA levels and debt levels, I'm sure we can't skip the discussion about the new age tech companies, be it something like Paytm or Zomato or Nykaa, whatever. Uh, Now, many of the investors actually did invest in their IPOs just because यार Paytm तो पता है, Nykaa तो पता है. So many a times it does happen that just the familiarity of the name is the sole thing because of which a lot of investors actually jump and buy into these stocks. I whatever I have observed is that whenever the markets are in the bull run, generally the market doesn't pay a lot of attention to their PE parameters or whatever is the scenario. Everything is whatever you buy today, you will be in a position to sell at a higher price in let us say a day or a week or a month. Typically, when markets are in a super bullish trend, but the moment markets start turning jittery, those companies which don't have strong fundamentals, those companies wherein I can say the P's are at a very high level, they are going to be the ones who are going to start crashing down very fast. So, what do you feel? If I'm talking about all these new age companies, is there any specific way that you analyze these companies, or is it the same three pointer analysis that you told right now?
सो एक्चुअली रचना कोई न्यू एज ओल्ड एज नहीं है, एज यू सेड सिर्फ तीन ही भगवान है निवेश में. पहला फर्स्ट गॉड, फर्स्ट मंगल ब्रह्मास्त्र. Are you making return on capital? And one of the reasons I'm saying there are only sort of three gods is I used to do it qualitatively. My colleagues and I used to do it qualitatively. 1.5 years ago, Krishnan joined us with his quant skills, and he showed us quantitatively the तीन ही भगवान है. पहला, doesn't matter आप your new age, old age हो, North Indian हो, South Indian हो, manufacturing में हो, services में हो, are you making return on capital above cost of capital? Most of the new age companies मतलब रिटर्न ऑन कैपिटल कुछ भी नहीं है, मतलब न्यूमरेटर में कुछ है ही नहीं, डिनोमिनेटर में भरा हुआ पैसा है, बट नो एबिलिटी टू जनरेट प्रॉफिट्स और कैश. Second is, are you generating any cash flow at all? Forget the business as a whole. When you talk to these companies, they'll say, "नहीं, business as a whole में तो मालिक we're not making money." That's because हमने अभी yesterday morning only we opened the Tripura branch, or yesterday evening we opened the Kanyakumari branch. They'll say something like that, right? We're pushing the border, we're pushing our business to the frontiers of India, and hence our business is not generating cash flow. So we'll ask them, ठीक है, forget the latest branch in Kanyakumari or Tripura. Uh, Take us to your core business where you started the franchise 10 years ago. Show us that you're making cash there, and you'll see वहाँ पे भी cash नहीं बन रहा, which means that fundamentally what is called unit economics ही नहीं है, धंधे में कोई दम नहीं है. They have raised a ton of money from some private equity or venture capital people. They have burst out the money on us. They are very grateful, right? We have got free pizza delivery or free sabji delivery, right? Long may it continue. Free bhaji delivery to the Mukherjea household is much appreciated. But God help the shareholders of these companies, because हमारे घर में अगर आप कांदा फ्री में डिलीवर करो तो हम तो लेते रहेंगे, आपका कुछ नहीं बनेगा जिंदगी में.
True. Absolutely. Krishna, would you want to add any point on this as to this? Because whatever I understand, you are the quant guy. So, any specific quant that you want to add for the new age companies other than these three, if you have any specific perspective?
Yeah, so look, I mean, investing in IPOs has generally, not been a, good, like a good investing proposition, not just in India, I mean, globally, right? So if you look at track record of, investing in, IPOs of any kind, forget about new age, not new age, it's not, it's not worked out generally, right? So at least, just going back to Meritor, because, that's what, I've been involved in. So we basically avoid companies which have been recently IPO'd in the portfolio. So we stay away from companies for at least a year till things settle down and we can, analyze these companies in better detail, right? Because again, there's a lot of what's called irrational exuberance, especially near IPOs of some of these companies. So it's better to, to stay away as much as possible.
Got it.
I mean, I have to confess, sometimes I go to watch movie first day first show. कभी कभार मैं करता. I did it for Pathan first day first show, but usually watching movie first day first show is not a good idea, because 10 साल में एक ही DDLJ आता है, 10 साल में एक ही बाहुबली, एक ही पठान आता है. 99 out of 100 first day first show are flops. And similarly in IPOs, 99 out of 100 IPOs आपका कुछ पैसा नहीं बनेगा, but the sheer novelty sucks people in, and as you were describing, they end up losing 60-70% of their hard-earned money.
Okay. Um, well, about IPOs, I have a little bit different, point of view, because maybe the way I have, of course, if you're investing in each and every IPO, then definitely, I mean, making money can be a big question mark. If one were to do a good analysis of IPOs, though, if we try and understand whether we are getting a good value buy, then does make sense. So, for example, like you said, if you're going to get a good DDLJ, if you are doing some you're doing some homework before the movie releases. So if you're good at that, then maybe you can go with conviction that okay, makes sense going ahead for a first day for sure. So I try to do, because even like you said right now, that Sachin Tendulkar did not become famous by watching the scoreboard, but by doing a lot of hard work, doing a lot of study at the Shivaji Park. Similarly, if you do a lot of study, if you do a lot of homework from the RHP, and if you can get some nice idea about the company, then my experience with IPO especially has been pretty good. I started back in 2006, of course, when there used to be firm allotment when you used to apply for the highest lot size. So my story has been a bit different about IPOs, but of course everyone has their own opinion, and I do respect everyone's opinions. So fair enough, of course, right? But moving on to the next question, I'm sure this question is I'm asking on behalf of every single person who is there on the stream, that when it comes to investing, just 5%, 10%, 15%, इससे कुछ नहीं होता, ये दिल मांगे more is what everyone is like, and everyone wants to find out multi-baggers. So if anyone were to find them, what could be the strategy for that? Any specific formula? Different Brahmastra part 2.
So when we wrote Coffee Can Investing, a few of my colleagues and I wrote a book called Coffee Can Investing in 2018.
Mhm.
What we showed there was there's a relatively simple way to invest successfully in India in the long run. By definition, if you want to have multi-baggers, आपको long run निवेश करना पड़ेगा, because short run में multi-baggers का formula I don't think we have, and whoever claims to have short run में multi-baggers का formula, I think they need a brain checkup before they need a financial checkup, right? So long run में multi-baggers, what is the formula in India? We showed in that book relatively simple formula. You're looking for clean companies, the accounting may pass ho jaye. First level is they've got to be clean. If the promoter is a crook, it'll be multi-bagger for him as he runs away to Dubai or London, but not multi-bagger for you and me. So step one, assess cleanliness of the promoter. Make sure he's not a chore using forensic techniques. Step two, make sure that his return on capital, as we were discussing a few minutes ago, make sure return on capital is come say come 15%, minimum 15% over a 10-year cycle, right? So it's the second layer. And third is look for proof of growth. Proof of growth as evidenced in a quant framework by double digit revenue growth over a decadal cycle, right? And we showed in that book, we showed in Coffee Can Investing, that if you can follow this disciplined formula, good accounts, 15% ROC or higher, 10% revenue growth or higher, you typically compound at 22, 23%. So if you take the rule of 72, if you're compounding at say 23%, every 4 years or so, you're able to every 4 years or so, or every 3.5 years or so, you double your money. Every 7 years, you quadruple your money,
Correct.
and every 14 years, you will have 8x your money. So this is the simplest formula. Krishnan then took this approach and turned it into what he calls Meritor Q, which is an improved version of this, where he added the debt equity parameter. He also said, not only do I want good ROC and good revenue growth, I also want low debt equity just to de-risk the portfolio further. And we've seen in India, Rachana, that if you follow this approach, आपका ये 20-21%, 20-21% returns become very doable, which, as I'm saying, following rule of 72, every 3.5 years, you're doubling your money.
20 to 22% you are saying CAGR for revenue or for PAT?
Then 20 to 23 is the returns of the portfolio.
Or returns of the portfolio? Okay.
Yeah, so the formula is clean accounts, ROC above 15, double-digit revenue growth, and Krishnan has added low debt equity. If you read my book, Coffee Can Investing, you'll see returns end up being 20, 21, 22% over last 10 years, 15 years. It's a very steady return profile, and every 3.5 years, you end up doubling your money.
Got it. Amazing. So basically, it is doable. I mean, it is possible that we can find multi-baggers by again sticking to the basics. So what people feel that they are required to know some fancy things in fundamental analysis, some very very lesser known ratios, or some from the annual report, some कहीं पे कुछ कोने में लिखा होगा, शायद वहीं से मिल जाएगा. There's nothing like it, right? It's your basics. If you stick back to your basics, still it is definitely possible that you can find out a multi-bagger and maybe stick out to
That's
that.
right. This
Absolutely.
discipline and patience. If you have that, again back to cricket, discipline and patience. Rahul Dravid, Sachin Tendulkar. That's what made them legends.
And consistency.
Hmm.
And even my viewers are also very consistent. They are going to understand my cue by now. They are very consistent. They'll come every Thursday. They'll watch, but they'll
Wow.
not do one thing. They'll not do one thing. अभी ये comments में भेजेंगे मुझे क्या नहीं करते हैं वो. कुछ भी हो जाए
अच्छा.
नहीं करते जब तक मैं नहीं बताती हूँ. हाँ,
अरे
आने लगा है. लाइक नहीं
चलो.
करते जब तक मैं बताती नहीं हूँ तब मैं. And they give up. So they're very consistent about that. Just watch, and then go away without liking the stream. So here's a big shout out, everyone. If you're loving this discussion, please smash the like button. That shows that you're enjoying this live stream. Right. Moving ahead with the next one. This is again a question that almost every single person has. Like we said, like assume that I invested in some XYZ share, got a multi-bagger return. Let's say it went up 2 times, 2x, 3x, 4x, whatever. Again, same thing. I'm not sure that whether I should be quitting at 4x or not, or whether I should be quitting at 3x or not, because every single time any individual investor feels that the moment I'm going to sell, that is going to be the start point for the true rally for that stock. Right. And the moment I am going to hold on to it, that is going to be the deep dive point for that stock. So everyone is really confused that what should be the cutoff point, when is the right time to sell. So any inputs on that?
So look, two approaches in our books, Coffee Can Investing, Diamonds in the Rust. In our books, we have said if you're a qualitative investor, right? Someone who reads annual reports and watches the fundamentals, then three things to look out for. Chori. If you watch chori, get out. Right? It doesn't matter PE multiples ज़्यादा है कम है. If you can see the promoter stealing money and CAs like you, my next life I want to be born as a chartered accountant in India, right? Thankfully in our office we have 20 such smart CAs like you. As soon as they tell me chori, I ask the promoter, Malik chori kar rahe ho? He usually says no comment, which means chori kar raha hu. So we get out of there as quickly as possible. Second is you see lethargy, right? Promoters become a multi-billionaire. He's now spending a lot of time playing golf or doing charitable activities. Franchise is weakening, competitors are coming in, time to check out. And third is poor capital allocation. बहुत सारा company generating lots of capital, lots of cash, but Malik is not investing it properly. Return on capital is going down, right? So these are qualitative signals: chori, lethargy, and poor capital allocation. In the quantitative framework that Krishnan uses, he's very smartly translated this into a two-part story. One is if the fundamentals weaken, if the ROCE starts coming down, then his quant framework starts saying time to reduce the position, perhaps even get out. And the second is perhaps the fundamentals are not weakening, but price to free cash flow. We believe PE multiple थोड़ा सा useless चीज है, right? Price to free cash flow, right? Price to free cash flow has rocketed through the ceiling. Share price has risen far more than free cash flow. Then his merit or quant signal starts saying that either reduce the position or get out. So Christian's taken our qualitative approach and translated into quant. यहाँ पे ROCE और price to free cash flow के basis पे the stock is either position sized up or down or perhaps exited entirely.
Got it. Wow, I mean, whatever parameters you discussed right now, they were amazing. But there's a genuine problem of so many people. Like you said, that कहीं चोरी तो नहीं हो रही है, या फिर price to free cash flow and all these things. For a person who is doing a full-time job, if that person were to look through all these parameters, and assuming that the person has long working hours, then in such a case, how can a person tackle this situation?
Right. I think if anybody has a job in India with short working hours, मेरे को बताइए, मैं भी ऐसा जॉब ढूंढ रहा हूँ. I think everybody in India has long working hours. I get a lot of grief.
हमारे ऑफिस में 10 to 6 होता है, बहुत स्ट्रिक्टली.
अरे बहुत ठीक है.
बहुत
अभी मैं CV भेजता हूँ आपको, रचना जी. So for people with long working hours, which is pretty much everybody out there,
Yeah.
my suggestion would be think about getting an investment advisor. SEBI website has I think 1200 RIAs ka email address, naam, etc. Um, uh, uh, in the context of taking an investment advisor, look for someone who can give you a disciplined, rigorous approach. Remember, with an investment advisor, the investment advisor is telling you this is what you should buy, this is what you should sell. It's up to you to decide
Mm,
what to do or not. So you worked hard in the office. You have just about enough time to talk to the investment advisor, say once every 3 months. The
mm,
investment advisor says, my advice to you is please buy A, B, and C. You can then
mm,
use your training, your education to either agree or disagree, act on those decisions, act on the advice, or not act on the advice. That is something I think most of the people who are on this show, watching this show, will have the requisite education and judgment to do. And therefore, if you have a busy job, get an investment advisor. It's in that context actually. 1.5 years ago, we hired Krishnan. He passed the relevant exams, and he used his training, his quant training at Goldman Sachs, at DE Shaw, at Morningstar, to create this investment advisory framework where Krishnan uses, as we were discussing, first step forensic accounting. He uses a disciplined forensic accounting algo to to eliminate the naughty companies, the chore companies.
mm,
Secondly, he uses return on capital and debt equity to say which promoter is doing a sensible job of running the business, acha business, high ROC, low debt equity. And finally, he uses price to free cash flow to say amongst the good companies, which are the ones where the valuations are particularly attractive, and he says
mm,
isko jada lo. And he comes up with a portfolio which we offer to clients on a advisory basis. If clients want it, they can buy the whole of it, they can buy part of it. It's entirely up to them. But what we have found, we have around 200 people I've seen, and I've
mm,
seen the typical profile is people who are in middle management, senior management, in demanding jobs. They're earning reasonable amounts to invest well in the stock market, but they don't have their money rich, time poor. And for
mm,
money
mm.
rich, time poor people, the investment advisory approach becomes a sensible approach. Krishnan, do you
Got
want to give your thoughts as well on this?
Before Krishna, you give your inputs. One quick question again. Many people ask this question to me because is there any specific ticket size for this? I mean, can a person start with a what is the base minimum amount with which a person can start with this? And then you can give inputs.
I can answer that, Rachana.
Yeah, sure,
Or
please.
okay. So the minimum ticket size is 10 lakhs.
Okay.
And so this is an investment advisory portfolio, like Saurabh said. So this is available on a platform called Desk, very similar to Small Case, and it's also available on our website. So
Mhm,
if you go to our website, www.marcellus.in, you just there's a tab called Invest in Merit or Q, and then you need to complete a few steps. Just register yourself, and then you need to link your demat account. So the requirement here is you need to have a demat account to invest in this product. And we will not be taking your money, remember. So this is
mm,
because this is an advisory portfolio. You will be subscribing to this portfolio, so you pay us the fees, to get the portfolio, the list of stocks, and then when you click a button, the trades get executed, but the stocks then sit in your demat account,
mm,
right? And every once in 6 months, what we do is, we refresh these portfolios per the rules. I think Saurabh already talked about those rules, the three Brahmastra. And so, we repeat that rule. So that's something we do. So I'll be, sitting and, refreshing the portfolio per exactly the same rules.
mm,
And then this will be reflected again in the, whoever subscribes to this product, right? So
got
every once in 6 months, you get a notification once you're subscribed to rebalance your portfolio, and then again you need to just click a button, and all the trades will get executed. So all the buys and sells, uh, whatever changes need to be done, that will be done, right? And maybe just to add to what Saurabh also said,
mm,
look, this entire methodology for most parts is, again, it's completely driven by this set of rules, right?
mm, mm,
I think if people have questions on their mind, do we have, some kind of, we are taking qualitative judgments? No, we are not, right? This is
mm.
completely a rules-based portfolio, so we are
Correct.
completely looking only at factual data to
Mm,
build this portfolio, right?
mm,
We are not looking at any judgments, any analyst estimates, so on and so forth, right? So it's completely
mm,
factual. And whatever rules or the parameters Saurabh has mentioned, we follow the exact sequence in that order every once in 6 months, and that's how the portfolio gets built, right? And that's the power of the process, right? So investing again is I'm sure your audience would understand better than most that it is a probabilistic exercise, right?
Mm,
It's only with a good process and a disciplined process that you can make money consistently over long term. So this is
mm,
what this particular strategy helps you to do. So you don't have to worry about how your money is being put to work, what stocks you have,
mm,
because the kind of rules we have in place would ensure that the set of stocks and the portfolio would consistently keep on generating the returns, right? So we have also tested this over a 16-year period from 2006 to 2022, and we found that again it gives you, if you follow the same rules, again for exactly the same sequence, it generates anywhere around 20 to 21% cross of fees, but we don't assume any reinvestment of dividends. So again, this is like, yeah, go ahead.
sorry. So, do you have the same set of rules, whether it is a small cap or a mid cap or a large cap across the board, or would they be different based on the market cap?
No, so this is it's an all cap portfolio. So we start from the BSE 500 or NSE 500 universe. So this would be large, mid, and small caps. And at any point in time, the portfolio, the composition could again be anything, right? So it could be like right now it's around it's dominated by small and mid caps. That could be a point maybe in the future where it could be dominated by large caps also.
Got it. Got it. Amazing. I think it's fantastic inputs. There are people who are saying that yes, impressive discussion is what I read in the comment section right now. There are a few questions which are being asked by the viewers. Would you want to answer few of these? Totally up to you.
So we'll try our best. Yeah.
Cool, cool. I would not take any stock specifics as such, so that the discussion is more generalistic rather than, because फिर सब अपना portfolio का एक एक pain point आगे लाना शुरू कर देते
And
हैं.
yeah, and what happens ask about chore companies, and it becomes very uncomfortable.
Okay. So this question is by Sharman, and he says that after applying your 3 to 4 formulas, we find a lot of companies. Acha, he is saying that we found a lot of companies using your 3 to 4 formulas. How to do further analysis and find out some good 14 to 15 stocks out of those?
Okay, so I think I suppose let me first be clear about what Sharman might have applied. So Sharman might have read Coffee Can Investing, and he might have applied the ROCE and 10% revenue growth. So let me first address that. I'll then come to I'll request Ms. Krishna to then address the merit or Q formula wala sawal. So Sharman, if you ask me, right, the challenge with the Coffee Can Investing formula today is actually the reverse. Remember, the Coffee Can Investing formula is every single year for 10 consecutive years, company has to do 15% ROC. Very few companies in India will make it through that, right? Especially the COVID years, may ROC got absolutely pulverized. So if I take the last 10 years, every single year, 15%, barely 25, 30 companies in India will make it. Second, on top of that, you now have to apply every single year 10% revenue growth. You can imagine that COVID wala saal, revenue growth 10% to almost kisi ka nahi hua hoga. So in
Correct.
fact, the challenge with the traditional coffee can investing formula, when I wrote that book in 2018. It worked beautifully, but because of COVID being such an exceptional disaster, COVID year being such an exceptional disaster, that 10% revenue growth almost nobody passes anymore, which is why we had to tweak it to come up with Krishnan ka merit or Q wala formula. Krishnan, do you just want to repeat the merit or Q wala formula and give a sense of how many companies pass that quant approach that you take?
Sure. So we start from the 500 stock universe, like I said. So this is an all cap universe. From that, once we apply our forensic screen, roughly, we lose around 200 odd companies. So we're left with around 300 odd companies. From that, again, if you apply the second Brahmastra, which is your debt to equity, the debt to equity ratio. So we, again, remove companies which are over leveraged. And then we also look for consistency of the profitability, right? So this is the third step. So after these three steps, we are left with around 80 to 100 companies. On these 80 to 100 companies, we look for companies which are both profitable as well as undervalued. And when I say undervalued, again, going back to what Saurabh mentioned, we're looking at undervaluation with respect to their free cash flow generation ability, right?
Hmm.
So if the
Hmm.
company's price is cheap, or is it looks undervalued with respect to its free cash flow generation ability, we say that it's undervalued, and that's one component that goes into the selection, right? And we select anywhere between 35 to 45 stocks in Meritor at every rebalance, right? And companies which are more undervalued are given a higher allocation in the portfolio, right?
Hmm.
Uh, and this because the selection step itself ensures that we select at least 35 to 45 companies. I believe you'll never get to a point where you'll have to bring down the portfolio, the portfolio stocks to anywhere like 20 or something like that. So this is a much more bigger but a more diversified portfolio. But again, that's how again, given the testing we did, we felt that this would be more suited for this quantitative approach we have taken.
Got it. Got it. One question from again one of our viewer is, how do we find ROC for past years, and for how many years do we need to apply this? Because majority of the website, something like a screener or a money control, would show ROC for that specific year,
Sure.
historic
So
data
look, I
considered.
think the easiest thing to do is, I mean, the easiest thing to do is, if you can afford to buy a database, there are several available in the market. There's Ace Equity that we use, but there are others available as well. Typical database में ये ROC का data, the database calculates and gives it to you, but it costs a little bit of money to buy these databases. So if you don't want to spend the money to buy the databases, go to the company's website. Annual report is free. All
Hmm.
companies by law have to put up the annual reports for free, and the annual reports will, most companies, the annual reports will go back 10 years. And then the formula for ROC is very simple. आप एनुअल रिपोर्ट से डेटा निकाल के फॉर्मूला अप्लाई कर दीजिएगा. वी हैव गिवन द फॉर्मूला इन डायमंड्स इन द डस्ट. इट्स सिंपल. न्यूमरेटर में आप अर्निंग्स बिफोर इंटरेस्ट टैक्सेस एंड अर्निंग्स ले रहे हो, सॉरी इंटरेस्ट टैक्सेस एंड एमोर्टाइजेशन ईबिटा ले रहे हो न्यूमरेटर में. डिनोमिनेटर में take total equity and total debt. Keep it simple. Denominator is total capital employed, total equity or total debt ले लीजिए. For debt free companies it's only the equity, and that's it. That's all you need really. So numerator denominator calculate कर लीजिए. It's good practice as well.
Yeah.
The more you calculate these things on your Excel, the more intuitive understanding you develop of businesses. But yes, and if you are in a tough job, right, you're working in a demanding job, I appreciate that coming home and opening the annual report and calculating 10 years of ROC is not exactly a leisurely relaxation time in the evening, which is why I was suggesting use an investment advisor, because everybody needs some space and time to unwind.
Got it. One industry level question, because we have been talking about in general, filters till now. There is this industry related question. No need to go stock specific, but chemical industry, this sector as a whole, specialty chemical. Uh, what do you think? What is your view on this entire space that is being asked?
So I don't think, look, I mean, firstly, never get focused on industries, right? In any given industry, there'll be so much wide divergence. There'll be the Sachin Tendulkar player in the industry, and then there'll be the local gully ka cricketer as well. So no point saying you like cricketers or you like footballers, you like tennis players, you're overweight tennis, underweight football. That sort of stuff is mumbo jumbo, right? Identify the star cricketers, the star tennis players, the star chemical companies, the star IT services companies. Star in what sense? Firstly, honest, clean accounts. Secondly, competent, good ROC, low debt equity. And thirdly, for their honesty and competence, on price to free cash flow, very reasonably valued, right? And you'll find that in the chemical industry, in the FMCG industry, in the banking industry. So never get lost in this industry analysis ka jungle. Once you get lost there, no, then the whole world becomes a complete jumble of good and bad companies in every industry. And then somebody will tell you low P ले लीजिएगा, you'll buy a value trap, a naughty company whose numbers are inflated, whose E is a fraud number. फिर आप लो पी लोगे, कब प्रमोटर भाग जाएगा, आपका पैसा बर्बाद हो जाएगा.
Got it. A question, Krishnan, if you want to answer this. What are the charges? क्योंकि सब बोल रहे हैं हाँ ये तो ठीक है कि हमको अच्छा अच्छा मिल जाएगा सब रेडीमेड, हमको कितना देना पड़ेगा?
No, so this is available for 2.25%. So this is only a fixed fee product,
Okay.
and it is charged quarterly. So 2.25% annual fees, but charged quarterly.
So
Okay.
divided by 4 कर लीजिए. So every quarter you'll end up paying basically 60 of yeah 60 bips 60 bips or a little below 0.6% every quarter, and
On
every
the
quarter
investment
you
amount, is it?
on the invested amount, and then every quarter you get a chance to you can renew every quarter. If you don't like it after one quarter, you'll say मेरे को नहीं देना और
Hmm.
and obviously then there is no charge to be paid.
So there's no
Uh,
lock-in as such, basically.
So, yeah, and it's your money, it's your demat account. As Krishnan said, in your demat account, you're being offered a portfolio of stocks. You might say, I like 20 of Krishnan stocks, the other 20 I don't like, right?
Hmm.
So that's
Hmm.
also fine. I mean, it's entirely up to you. You might take one out of the 40 stocks, 39 stocks you might reject. You say, नहीं यही एक stock था, मेरे को इसी का इंतजार था, right?
Ah, absolutely amazing. Wow, I mean, believe it or not, it has been 45 minutes since we started the discussion. It was a fun discussion. I left the match. I'm sure you also did. I don't know who won. India versus Australia. It was the semi-final. That did any idea who won, who lost? India was going very great.
I think if we should just carry on the discussion so that we don't have to deal with that news. मेरे को पता है क्योंकि मेरे घर में कुछ लोग वॉच कर रहे हैं, बट looking at their faces, I think मेरे को पता है आउटकम
Oh
क्या हुआ
my
है.
God, India lost. अरे यार, मुझे अभी पता चला. Shit. Okay, we won in the discussion, but
Don't worry, the good news is the WPL में इतना पैसा कमाएंगे that they will need investment advisor like Krishnan. Think on the
oh,
positive side में इतना कमाएंगे. स्मृति मंदाना 3.5 करोड़ कमाएगी, उस पर खुश होना चाहिए हमको.
absolutely. I loved the Amul ad. Smriti dhan dhana dhan.
And I think Rachna, that is the new India, right? पैसा लोग मेहनत कर रहे हैं, they are earning money. We are also good at saving actually as a country. We save lots
True.
of money. जो इंडिया का historical problem रहा है, people have taken that money and bought flats and gold and done fixed deposits. And through our books, we are trying to change that habit and
Hmm.
saying मेहनत कर रहे हो, कमा रहे हो, invest in good quality companies and
Hmm.
get the returns that you deserve for your hard work.
Absolutely, absolutely. I think amazing. It was great talking to you all. Wow, I think we should do this one more time. Part two
Love
discussion.
to.
We should do it
We're
if
good fun,
everyone.
Rashna. Thank you very much. Thanks a
It
lot.
was fun talking to both of you. Thanks a lot for taking out time from
My
you.
pleasure. Thank you, folks. Thanks for joining in.
See you
Thanks.
all.
Bye for now.
I'll see you all, everyone, on the next Thursday live stream. Till then, take care. Jai Hind and bye bye.